Danny,
Yeah,
how's it going?
pretty good. Busy week, but doing good. How about you?
Nice. Good, good. I actually, I need to tell you something.
Okay.
I started a business recently.
Another one?
Yeah,
Okay.
another one.
And what is this
Yeah,
business?
I'm, I'm building boats, in my attic.
I don't think that's going to turn out very well. How are you getting those out?
Honestly, sales are going through the roof, man. It's pretty great.
Oh, man. Dude, you're killing me. You're killing me with these. Your
All right,
sale is
well,
going through the roof.
if
All right.
if you're still with us after that joke, then you are in really good company. Welcome to the Financial Philosophers Podcast. Today, we're not talking about building boats in your attic as a business, but we are talking about a certain type of business. And this is more of a thought experiment, but I think it's a healthy way to look at yourself. And that is to start thinking of yourself as a business. So, what do we mean by that? I would argue that every single person in this country is a business owner. And you are the business and you own you, right? So you could call it the you business, right? And we're going to explore this concept today. We're going to dive in and see what this means and what kind of implications it has. Have you ever thought about this perspective before, Danny? Has this concept ever crossed your radar before?
I would say that in some ways I manage my finances kind of like a business, but certainly not in maybe to the detail or the level that a proper business does.
That's fair.
One thing before we jump in, I wanted to mention in a prior episode, you had said that the volatility in the market can be tormenting for people that are trying to reach certain levels, especially if you expect a higher level of return in order to reach those levels. And I recently heard a quote that torturous volatility is the price of admission for those compounding growth levels. And I just thought that was really impactful, and I wanted to mention it.
It's like you're not going to be able to invest unless you're willing to pay that price of admission, which is going through some level of torment.
Absolutely.
Yeah, that's pretty profound. I think it would be awesome to do another episode soon about returns and taking even a broader stance beyond the market. But I mean, even when you mention torment, right? Thinking about like when you invest in the markets, you're investing in businesses, right? And the process can be tormenting. And you could tie that same concept to the you business, right? I mean, think about the journey, and not just you, Danny, any listener right now, think about your own personal journey. Pretend you are a business, right? The you business. I'm sure we've all been through very tumultuous, volatile moments in our lives on our own personal business story, if you will. And the funny thing is, I guess that's a price of admission as well, right? We don't really have a choice in the matter. We're kind of thrown into life, and we have to figure out how to manage our finances and make them count and be a good steward of our finances, right? And manage that volatility and that pain. So, yeah, I don't know about you, but I've running my own business, my business, has not always been an easy process.
Definitely. It's definitely gotten easier and in many ways more automated, which I think contributes to a lot of the ease of just moving through life is automating as much as you can. But when you start out, when I was getting out of college and I was stuck in the Midwest, waiting for my wife to graduate and looking for work and saddled with a bunch of debt, I was not a very profitable business, that's for sure.
Yeah, I know your pain. I mean, but here's the thing, right? If an outsider was looking in at you and trying to value you as a business, right? They at face value may not have seen a super promising picture, right? But you know yourself and the you business better than anybody else does, right? And so, we can see our own potential much greater than anybody else can. And I think it's important to remember that, right? Like, especially when you're going through a really tough time, you're experiencing personal volatility in the you business. It's important to remember how much value there is still there and how much value you're probably going to unlock in the future as you grow your income and as you pay off debt. I think that's an important factor to keep in mind when going through that tumultuous time in your life. Thinking about, the you business, right? Let's take a step back really quick and let's talk about regular businesses, real businesses, right? Businesses you could go and invest in the stock market, for example. Think about what makes a good business or what is a well-run business. What do those types of businesses have in common, right? Well, if we start listing off some things, I jotted down a few things that came to mind. One is hopefully they have stable revenues, right? They have some form of recurring revenue either through sales or services provided. But taking it a step further, hopefully they're also growing those revenues, right? That's even better than a stable revenue is actually growing those revenues.
Yep, gaining that market share.
Yeah, well, then there's also volatile revenues too. Some businesses don't have consistent revenues, but hopefully they're offsetting that in other areas that make them a healthy business, like having little or no debt, right? If you're investing in a business that has a lot of volatility in its income and its revenue, seeing a healthy balance sheet is going to give you a lot of peace of mind because they're probably deploying other assets to grow that revenue and make it more stable over time or maintain a competitive edge. So
yeah, and the different kind of businesses are going to have different kinds of assets and debts as well. A real estate company is going to have far different debt levels than a Japanese game company will.
Nice. I see what you did there. Yeah, definitely, right? We can't just discount debt and say it's bad in every situation, right? Businesses that use debt strategically or very responsibly, that's a good thing, assuming that it is being used responsibly. And like you said, real estate company, you might have to take on debt to leverage those dollars and purchase, new commercial real estate that maybe you're renting out or whatever the case may be. But yes, stable revenues, growing revenues, little to no debt, or using debt strategically or responsibly. Another thing that really well-run businesses do is they know where every single dollar is going, right?
That's very
well
true.
documented. It's tracked meticulously. You could liken this to generally accepted accounting principles,
yep,
right?
GAAP accounting. That is
exactly.
something that I think a lot of small or startup or very small businesses struggle with as they transition to that medium and large enterprise stage is transitioning from the initial, like, oh, we're using QuickBooks. Maybe I shouldn't be mentioning individual companies. I don't know. But, they're using maybe something that's meant for an individual or a very small company. And then it's always a rough kind of transition as you move into that large enterprise space and trying to kind of bring in the public accounting principles, right? The principles and the expectations that are seen on within public companies.
Yeah, definitely. To throw another wrench into the mix, some companies, just by the nature of their current financials, like you were mentioning, these companies in that kind of that small space who are really trying to grow, they may not even be GAAP profitable, currently, and it may be years into the future before they become GAAP profitable. But that doesn't mean that they should be skimping on documenting and tracking their dollars meticulously, right? So knowing where the dollars are going, knowing that it's documented and that it's being tracked is a good sign of a well-run business. And speaking of those dollars, having intention with every single dollar they deploy, right? Like if you were looking through a business's expenses and you could see where they're sending their dollars, what they're purchasing, what the dollars are being used for, or revenue in this case, it's going to give you a lot of peace of mind behind your investment if you can look through each expense and say, I totally agree with that expense that they did. It's when you come across those expenses where you're like, it doesn't seem like there was a lot of intention behind those dollars they deployed. I don't know how I feel about that expense they took on.
Yeah.
Or this new thing
Why did this company expense a $10 million trip to the Caribbean? Probably not a great thing.
networking, right? I mean, you gotta like really get out there and network. I mean, seems reasonable.
They
to me.
documented the exact return on investment from that trip. Yep.
Yeah. Yes, passed it on to shareholders. It's all documented. Very prudent. So, being intentional with those dollars, that's a good sign of a well-run business. And the last thing I thought was they manage risk, right? They protect the business. I mean, when you know the value of the business, you bet you a well-run business is going to take steps to protect that. They might diversify revenue streams so that if one area of their revenue goes under or hits volatility, they can fall on other sources of revenue and reduce that risk. They might be spending money in research and development, right, to future-proof themselves, to continue to maintain a competitive edge or innovate. And they purchase insurance. Businesses have a lot of insurance for their assets, for their employees. Key employees in a business, if a business relies on one particular employee or a group of employees, and they would suffer a material loss to revenue if one or some of those employees were to be injured and become disabled or die, businesses insure against that. They take a lot of steps to manage risk and protect their business. All of these things point in the right direction for a well-run business. And,
Okay.
why, right? Like, why is this important? For one, the future of the business literally depends on it, right? The business does need to operate soundly in order to continue to exist in the future. But the other thing is that businesses have shareholders, and they count on it, right? I mean, how would you feel if you had invested your hard-earned money in a business that you thought was going to pay a return to you over time, and they weren't living up to your expectations? That could cause a lot of stress.
Yeah. I think that also something to keep in mind is the amount of your net worth that you've invested into that one particular enterprise is also going to affect the amount of stress that you experience. If I had put 5% of my portfolio or 5% of my capital into one business, but I've diversified across, another 19 different areas, then one failing is not going to hurt me as much as if I put all my eggs in one basket. So,
right. That is a really good point, and I actually want to come back to that in a minute. So, yeah, I mean, you're right. Things that could cause a shareholder in a business to feel stress or be disappointed in the business is if the business was struggling to make revenue or grow their revenue, or weren't taking actions to stay competitive, or if they taking on a lot of debt, right? That's going to cause stress for some people, or if they're using debt in irresponsible ways. If they're not keeping good track of their dollars and documenting everything, if they weren't following accepted accounting principles, that's going to give you cause for concern, right? If any of these things were true in any of the investments you held, you have every reason to be stressed and to have doubts, and be concerned that the business will not continue to perform into the future. And I want to take a spin on this now, since we're talking about shareholders, right? When we come back to the you business, right? Let's bring this back to what we were talking about originally. Okay. We're thinking of ourselves as a business.
How are we a business? Okay.
Yeah. So our business, the you business, has shareholders. For starters, you are a shareholder, right? You're also the owner, but you are a shareholder of that business. Other important people in your life are shareholders too, right? A spouse could be a shareholder in the you business. A child could, a sibling, a family member, a close friend, perhaps.
Okay.
Anybody that depends on you, right? Where Eh,
I just have a
Go
quick
ahead.
question about it. Would you
Yeah, yeah,
would you say that it really comes down to the dependency, right? So a sibling or a friend will have less of a stake, as long as they aren't living with you, essentially.
yeah,
Okay.
yeah. I think that's the majority of it, but I think we are dipping into more of a personal and emotional side of.
Hmm.
There's an element there, right, that doesn't exist in just like cold investments in the stocks
Yes.
in stocks market or in businesses. Um, it could literally be a material dependency, right? Like somebody depends on your future earnings, your current and future earnings, um, eh, for the continued support and livelihood of your lives, or even maintaining a certain quality of life that uh, you and or perhaps your spouse, for example, have become accustomed to or have come to expect. Um, those are all true. Um, but the point is, there are shareholders, and most importantly, there's another shareholder we haven't talked about yet. It's here's the minor philosophy spin, but your future self, right? And I wanna explore this for a minute because
That
I think this is
that makes me think of the
important.
sorry, that makes me think of the joke where people will say, "Oh, that's a problem for future me." Well, that's very soon going to be a problem for current you.
I know it's pretty thought provoking. That is actually a really funny joke. Hopefully the the goal of this episode would be to make someone motivated to care more for their future self rather than push off the problems
Definitely. Let's
to the
get to work on
future
that stuff
future
now.
me. Yeah, I mean, it's an important concept, right? The future self. I think it's healthy to think of your future self as a separate person, a different entity, right? It's you, of course, but think about think about where you are in life right now. Every single person can look back and say, "Gosh, I really wish I had done something differently." Right? I wish I did this instead of that. I wish I had taken these steps preemptively, proactively to have a better outcome. I wouldn't be dealing with this problem today if I had done this before. I'm not asking anyone to live in regret. We all hindsight is always 2020, right?
Absolutely. There, and
Um,
if you want to be truly philosophical about it, there is the fact that if you had done any single thing differently, you would not be the same person you are today,
True.
right? You
I
would not
mean,
have the same
look,
experiences. You would not have the same perspective. For a few people, maybe that'd be a good thing. But for a lot of people, you simply would not be the same person. And so obviously everyone has things that they wish they hadn't done, but your best course of action is just learn from those and move forward as best you can.
I totally agree. It's looking at the silver lining, right? The lesson to be learned from any regrets or mistakes we've made, and maybe not mistakes, right? Maybe there were just less efficient actions or decisions we took in the past that could have been improved upon. The goal is not to feel regret or to beat yourself up about it. Um, and you're right, we wouldn't be who we are today. And thinking of your future self, I think, is just another exercise. Just like other things are good for you in life, right? Exercise or meditation or eating healthy. Thinking about your future self is a way to remind yourself that, hey, I'm going in 10 years from now, I'm going to have, I'm more or less going to be the same person, but I will likely have new goals and aspirations that will manifest at that time that I may not even anticipate yet. Not to mention, I have goals and aspirations right now, and I don't want to get to that point. I don't want my future self to suffer for my inaction today. It's just an exercise to go through to remind yourself to think about your future self more often, and think of that as a shareholder in the you business, because they are.
Absolutely.
Um, and there's one little twist here that's a little bit different than shareholders in businesses in the stock market.
How so?
If you well if you invest in a company in the stock market and that company really performs poorly and they make terrible decisions and they truly disappoint you and you have no logical reason to continue to invest in them, you can walk away. You can cut your losses, you can step away. You are not bound to that business.
Yep.
But the you business, there are shareholders that are bound to it and cannot walk away. And that's you, that's your future self. To some extent, you could argue it's your spouse or children, but less so, to a lesser degree. There's less choice in the matter, right? So that just puts a more important emphasis on operating in a sound way, running your finances, being mindful of the you business, and taking actions to run a healthy you business, if you will.
Yeah. So,
And
I suppose for anyone listening, then that should let this be your impetus to whatever you've been putting off. Get started this week, right?
yeah,
It doesn't matter what it is. If you spend 5 minutes taking an action towards something you've been delaying, you're making progress. So just take a day this week and take the leap and get started with in something you've been putting off.
I love that. And you're right. I mean, it's just little steps that count, right? Like, it's so much easier to think of things in bite-sized chunks and making small decisions because they add up so profoundly, rather than looking up at the top of the mountain where you want to go and thinking, oh my gosh, I have such a long way to go. It's like, you know what? Just get around the next bend. Just walk down the path or the trail and get to the next turn and then see where that goes, and then look for the next turn ahead and get there and make that next turn. I think that is a healthy way to make better progress.
Absolutely.
And yeah, I mean, like, if we go back to some of the questions we were talking about earlier, but we now look at it in the light of the you business, right? Put that in the spotlight. What makes a good you business? Finding a way to make your income stable or grow your income, right? Having little to no debt. And if you have to take out debt, use it responsibly, right? Maybe you're responsibly buying a house and taking out a responsible level of a mortgage or student loans to advance your education, which will hopefully contribute to growing your revenue, your income, right? Know where your dollars are going. Nobody likes to be told to budget. Like, it's just kind of like, it always feels like, the parent who's lecturing their child, like, or some adult lecturing the child, like, you got to have a budget. I always got so annoyed when people told me that, but thinking of it through this lens of like yourself as a business, I've appreciated the budget a lot more.
Yeah.
It's like, no. Like, having intention with where those dollars are going, knowing where they're going, knowing exactly how much free cash flow you have each month and what steps you could take to even further increase that free cash flow, which would only accelerate your savings rate and paying down debt, and what that does to, your ability to save even more or to reduce risk in your balance sheet. Know where your dollars are going and have intention behind them.
Yeah,
and
definitely. And I have a thought on that. That very kind of stringent and defined budgeting does not have to be forever. Once you've budgeted, and you've gotten debt under control, if you are mostly debt free, when you've reached that point, you no longer have to worry about where every dollar is going. You don't have to follow a, envelope or bucket method. You can literally begin functioning solely in percentages at that point. If 30% of your income is going to investments and savings, and all your needs are within that 50% bucket, then if you want to, and you want to improve your quality of life today, you can allocate 20% of your total income to guilt-free spending and not be concerned with every single dollar, as long as you're within those percentage parameters. And it just becomes much more automated and much more relaxed.
Yeah, I mean, not everybody's going to be a meticulous number crunching budget master, right? So, but to your point, I mean, gosh, make a one pager. Like, literally just put some things down on one page and get a sense of where your dollars are going. And like you said, once you have a sense of that, you could easily see some quick percentages. Like I know that of my total pay, I'm paying about this percent every month or every year towards debt payments, and I'm saving about this percent. And even looking at those two things and paying down debts and seeing that percentage decrease, and then having more to save and seeing that percentage increase, that in of itself can be incredibly motivating and rewarding. So, the point is, put some intention behind knowing where your money is going and what you're doing with that money. And lastly, the last point we talked about with a well-run business is manage your risk, right? Protect the you business. There are ways you can diversify, right? You can further your education or skill sets to keep your ability to earn an income more future-proof, or even diversify your ability to earn an income and stay competitive in the job market. You can have insurance to protect yourself against loss of life or loss of income due to disability. You can have insurance for your spending, and that's in the form of an emergency fund, right?
Okay,
If
I
something
was
were to
about to get
happen to
very
you,
confused and ask what you were talking about. So
oh, on
that you're essentially saying that an emergency fund is like a company's insurance policy.
in some ways you could
Okay,
view it that way, right? It's an insurance policy against volatility towards your income.
that's fair.
Something could happen where your income drops temporarily. Maybe you're in between jobs, or you lose a job, or you're injured. You could also explore actual insurance policies to protect against that too. But I think an emergency fund is even more fundamentally important for most people. Having some money set aside to protect we could do an entire future episode on this topic alone,
In
because there's
fact,
so much
we will.
yeah, there's a lot to explore on the topic of emergency funding, and it goes well beyond just the put 3 to 6 months aside for your living expenses. There's a
Yeah, I
lot of
definitely want
nuance
to. I
in there
definitely
to
want
explore.
to jump into that later on
Yeah,
because
we will.
that rule is kind of what I've always followed. So
Yep.
we'll have some discussion about that.
Yeah, teaser to all of our listeners. Stay tuned in the future for some episode on that. But this is just getting down to going back to knowing your financials of the you business, right? Like your budget would be like it'd be like a company's statement of cash flows, right? And your net worth would be like a company's balance sheet. In going to what you were mentioning earlier about knowing certain percentages, one common percentage that is used anytime you're financing for something, like if you're trying to be approved for a mortgage, the mortgage lender is going to look at your debt to income ratio. And that's just simply taking your total monthly debt obligations, payments, and usually whatever you're paying in rent, and dividing it by your total income, right? And there are different percentages thrown in out there that you can find online on what is considered healthy or a good range. I've seen anywhere from like staying below 36%, not having more than your housing or rent payment counting for more than 28% of your total income. Obviously, getting that number lower is better. And you could easily put that as one little number on a page. You could know what your debt to income ratio is. You could calculate it. And then as you pay off debts and or increase your income, that number is going to dramatically improve. And that can be
and that's
very
based
motivating.
on you typically do that based on your gross income, correct?
Yes.
Okay.
Yes.
I just ran that
Some,
number. I'm quite happy with it.
yeah. Isn't it motivating
It is, yeah.
when you see, yeah, it is. It feels good. It's like, like I'm in a healthy financial position. When lenders look at me, the thing they're going to say is, "Oh, this is a good borrower. Like I feel comfortable lending money to this borrower."
Uh,
There are all kinds
Chris,
of ratios you can
can
explore.
you lend me $100,000?
Oh, gosh, I'm
Okay, I'll
putting
take
you
that
on
as a
the
no.
spot. All right. Well, I'm gonna need you to send me all of the U business financials, please. I'm gonna need to see your balance sheet for the U business and the statement of cash flows, and I'm gonna need to see all your ratios, and we can talk off mic later.
All right, sounds good.
because I totally have 100K to just lend to you. No problem. Anyway,
Yeah,
we're kidding. But that going through your own financials like that is a healthy experiment, and it can be very motivating. And what's the point of all of this, right? The point is to have a greater sense of self-awareness of your personal finances, of the you business, right? Understanding where you stand financially and how actions you take can greatly improve your financial situation. It can be motivating, and numbers don't lie, right? I mean, when you even just on a one pager sketching it out, it's going to tell you things about your personal situation that maybe you hadn't thought about or even seen. Certain things you might have taken for granted. And awareness, being aware of your situation, is one of the most important steps you can take for actually taking further action in the future. And also, it's fun, right? Knowing your situation is empowering. And I think that's, not to zoom out too far here, but I think that's a big goal of this podcast, is to empower people, right? Is to give people the tools to think about their finances in a way that can enable them to take action to improve their situation and find financial freedom.
definitely.
Yeah.
That is absolutely the goal that we're all working towards.
Yeah.
Using those financial tools to take control of your finances, of your life, and build towards a situation that's just more stable, less stressful, and overall happier.
Yeah. I couldn't agree more.
I did have kind of an interesting thought about this. So we're looking at ourselves as a business,
Mm-hmm.
and obviously we've gone through all the balance sheet, income statements, free cash flow, all of that. But businesses are able to do something to a far greater level that I personally cannot, and that's write off expenses. Is so if we are viewing ourselves as a business, is there a way to practically apply that, or are we primarily, I guess, stuck kind of not being able to use that same tactic?
Ooh, that's deep. Oh my gosh. Honestly, I hadn't thought of it
Yeah,
that
and
way
we may not
before.
have time to dig into this, but
Well, you're right. We probably won't, but another teaser to everyone listening. We will do future episodes on some basic principles about taxation
mhm,
and getting into things like tax deductions and tax credits and what's the difference, and also certain tax write-offs. Certain deductions are actually deductions, where other tax deductions may just be punting off a future liability that you have to pay at some point.
absolutely.
Um, but to your question, we don't get to write off taxes in the same way that a business would,
Mhm,
right? Like if a business incurs an expense, and that they can write off that they can track that expense as something to deduct from their revenue, right?
mhm, before taxes.
And right, and the powerful part of that is that they may be leveraging that expense to materially grow the business in some way. Um, it's not as cut and dry as it would be when it comes to your first personal finances, but there are smart tax decisions you can make to try and perhaps replicate that to some degree, to try to squeeze out some value, some form of value from smart tax planning that would lend itself to running your business in a smart way, right? The you business in a smart way. I think you could throw into that list um, smart tax planning as a sign of a well-run you business.
Okay.
So that would be a great thing to explore in a future episode, and perhaps even multiple episodes. There's a lot that could be unpacked in the field of taxation.
Okay. So potentially in
But
the future, we'll do
yeah,
maybe a deep dive into specific, I guess, tax benefits or tax deductions that can be applied on a personal level versus
yeah,
the business level.
yeah. That's a really fascinating question. I have not thought of it that way before. I'm looking forward to exploring that. Um, but to summarize our points, I think as we wrap up today, I think the big thing we want you to walk away with is you are a business. You have shareholders. That includes you and your future self, and also perhaps some loved ones as well. Be aware of that and take steps with that newfound awareness to further your financial well-being, to further benefit the you business. I think that's what I would leave our listeners with.
I think that sounds good.
Awesome. Well, Danny, great chatting about this really cool topic. I hope you all enjoyed it, and we will see you all next time.
Have a great week.